Thank you, everybody. Welcome to the conference again. So let me briefly introduce myself. I am lucky to be the last speaker before lunch, so hang in there for a couple of more minutes. So a brief background of myself. I've been investing in emerging markets for the last 15 years. I'm on the private side of things, so I am in private equity industry. And I have around 3 years of investment banking experience and 3 years of management consulting before that. Also covering financial sponsors, private equity investors. So I have over 20 years of investing in the private space. And in terms of educational background, I'm an engineer, but I've always been in finance, so I never worked as an engineer. A brief introduction on the private equity shop that I'm a partner of. Türkven is one of the most established private equity shops in Turkey. We have been investing in that market for over 22 years. We're managing around $1.5 billion. We have made 30 investments to date, and in the portfolio companies we have around 50,000 people working. So we have been an influential factor in the Turkish economy. Our investors are the typical private equity investors, the sovereign wealth funds, the pension funds, investment banks, as well as fund of funds, so investing all around the world. And we were fortunate enough to go many cycles in Turkey, but still maintain a healthy return profile. So we are making around 25% in TL terms. Sometimes this is corresponding to a really high hard currency return. Sometimes it's not due to currency valuation fluctuation, which I will talk about. So after this introduction, okay. So I'll tell you why I think the investors consider looking at emerging markets in spite of everything. Everybody is aware that there is a lot of volatility, there is the risk of losing money, but still, when you look at a typical fund manager, you will realize that they invest around 10 to 15% of their assets into emerging markets. There are two main motivations for that. Obviously, one is enhancing their returns, and the second one is diversification. And the reason why investors believe that they will make better returns in emerging markets is a couple of factors. Let me go into those. First of all, if you look at through a long time horizon, emerging markets, which we call EM, grow faster than developed markets. There are a couple of factors for that. They have younger populations, there is urbanization going on, which means more financial inclusion, there is the GDP per capita growth, and there is the infrastructure growth, which is delivering all of this higher growth profile. There is, if you look at from the perspective of an asset manager, you have growth profile, you have a very interesting market, but then you have a lot of competition, which results in you overpaying for assets. So that's not something that we currently see in EM. In EM, if you look at the valuations compared to the developed markets, you see that there's a significant discount because the intensity of capital chasing assets is so much lower. So it's really much more possible to find attractively priced opportunities in the EM. There is also the technology disruption. We've been talking about fintech, or this blockchain, and if you look at EM countries, there is a lot of activity coming from those areas. I don't know whether it's the younger populations, the digital savvy crowd, the lack of old-fashioned technology compared to the developed markets, which drives that, but we see a lot of activity coming from the emerging markets. I mean, just to give an example from Turkey, we have two decacorns companies valued more than $10 million that we recently see, and those companies weren't around 15 years ago. So there is a lot of things going on in the fintech, in the e-com, in the digitalization side of even the most old-fashioned industries. There is the impressive entrepreneurs and management potential. I mean, the thing that defines the EM is volatility. So if you come across an entrepreneur or a manager which has been operating in that market for a while, that person typically saw a lot of crises, a lot of highs, a lot of downs, which builds a lot of experience of like steering those companies volatility? Well, we now know that like the investors look at EM, but how do they look at EM? First of all, we put a lot of countries with very, very different characteristics under one bucket. This is the MSCI EM categorization. Look at the countries under that. So there are very, very different places with very, very different profiles. So to be able to invest successfully in EM, one needs to understand the market that they're investing in. All EM is not the same, so we cannot use the same approach. And there are a couple of factors to keep in mind when we are doing that. The first one is economic activity. Is that a commodity-driven industry? Is that a consumption-driven industry? Is that a consumer growth story? So we have all these different strategies that we could deploy depending on the profile, the macro context of the geography that we're investing in. There is always the currency. Is it convertible? Some currencies are not convertible. So, although it's not just about convertibility, you may believe that it's convertible, but the liquidity is so low that it's in effect not convertible. And there is a lot of currency volatility. For example, when I started private equity industry in Turkey back in 2008, $1 was 1.3 Turkish lira. Today, $1 is 15 Turkish lira. So you have to be ready to deal with all this volatility. The other one is political risk. So, are there free elections? Is there a risk that the government may change soon? Is that a good thing? Is that a bad thing? Or what is the strength of the institutions? The Capital Markets Board, the central bank. So, all of these things make a huge impact on what happens to you while you're there. The restrictions to foreign ownership. Not all markets are free in every way. So, for example, there may be restrictions to buy real estate, there may be restrictions to own companies as a foreigner, and we have to make sure that we have a local partner who deals with that. So, we should always keep that in mind. And the last one is the limitations to capital flows. Let's say that you made a great investment, you made a lot of money, but can you take that money out of the country? So that becomes a really, really important thing. So this is a bit difficult to read, I'm sorry. The light blue line at the top, that's the developed markets, and the dark blue line below is the emerging markets. So lately, EM is underperforming DM because there is so much demand in developed markets that everybody is buying assets, the valuations are going up, and so it's, from a return perspective, everybody is making returns, but this shows you that where you enter and where you exit is very, very important. So if you enter at the time of the cycle and exit at a lower point in the cycle, then it is very difficult to make money. If you look at the last 15 years, EM underperforms DM. If you look at the last 20 years, EM significantly overperforms DM. If you look at 2008 to 2013, the picture changes. So we shouldn't just look at these graphs and try to make a conclusion of it. Things really change. I mean, I can give different perspectives, changing where I start in the graph and where I end. So in itself is not enough to allocate your portfolio. So you need to keep the perspective that things can change a lot, and you really need to look at it from different time periods to be able to understand what has happened. So this is the current valuation in emerging markets. The S&P 500 is currently trading at 17 times the 12 months price to earnings, whereas EM is trading at 10, so there's a 70% discount. Obviously, there are reasons for that, so I'm not here to claim that it shouldn't be like that, but it's just showing you the range of valuations. And within EM, for example, currently Turkey, the Istanbul Stock Exchange is trading at 4 times. And so that means that some companies trade at lower valuations than the cash they own. So there is really opportunities that one can find among these stock indices. To that. Okay, so when you are moving across investments in emerging markets, you really need to think about the macro. So it's not like in a developed market where you can look at the industry, the business potential, the competitive advantage alone. The macro changes everything. Because it can trigger vicious cycles or virtuous cycles. For example, think of an EM market where the policymakers continuously make reforms, they are open to free markets, they make the institutions really, really strong, they welcome foreign investment. What happens is that we get a lot of foreign direct investment into that country, which creates a lot of new employment, which creates increasing GDP per capita, and all of this creates an economic prosperity in the country, which reduces all the social risks, all the social tensions, so reduces the political risk, and it becomes a virtuous cycle. It creates more employment, it attracts more investment. Or it could be a vicious cycle. The government does something really, really weird, which concerns the foreign investors. They get out, capital outflows, there is less employment, the living standards start to fall, and there is a lot of social tension, which also brings the risk of political instability into the picture, and then it's very difficult to make a successful investment in such a context. And within EM, the returns vary all the time. I mean, let's just pick up a year, 2016. The average return of investing in EM was 11%, but in some countries it was 55, and some negative 12. So you really need to know where you are investing in EM, and you really understand that market. So this is how, this is the strategy of the private equity shop that I work for. This is how we have to change our strategy depending on the different periods. For some periods, we have to bet on the consumer growth, the consumer story. We invested in the pay TV, the school chain, the hospital chain, apparel retail. Over time, that has changed. Consumers started to become less of a story because there wasn't that much GDP per capita growth anymore. And then we started to see a lot of digitalization coming into the industries. And then we started to bet on that. And now that the currency has been hit over the last 5-6 years, we have a big export story. So we are focusing on companies with a big export potential. To get into a bit more specifics, when you are investing in EM, it's very difficult to invest only in the public sector, because if you look at the stock indices, they are dominated by banks, telecoms, so it's really, you cannot really find a variety of assets that can give you the ability to deploy your investment strategy. You definitely need to look at private markets to be able to do that, private equity, venture capital, family offices operating in Turkey, very, very different structures possible, for example, and I'm sure that's true for all the EM. The second point that I would like to definitely share is, in emerging markets, time is the best due diligence item. I mean, the data that you can find is very limited. It's not like you can pull up people's credit scores, you can look at the history of the companies that easily through a desk research. You have to really rely on local knowledge, and the more you can take doing due diligence, the more you find about the company. So we should always make sure that there is enough time to do our due diligence, and we have local presence to be able to do that completely. And also, when you're evaluating different companies, look at the time frame of the company. I mean, survival of the fittest definitely lives in EM. So if the company has been around for over, let's say, 20 years, that means that that company was able to steer through many different volatility periods. So it must be doing something right. So in itself, it is a good check factor to say that this company was able to ride through the volatility. People we deal with, they are not easily referenceable. So we cannot, as I said, we cannot just ask for a credit report and see what that person has done. We really need to rely a lot on local connections to be able to find out. And that's why also time becomes a very, very important factor in doing due diligence. And I'm sure that many people relate to this in the EM, it's more the corporate and personal financials may be a bit more entangled. So you look at a typical company, you see that the founder's house is there, his car is whatever, and then there is a lot of relationship with his other businesses, and there's a lot of this entangling that you need to do before making sure that you are protected as a third-party investor. And that's also very important to be on the ground and doing this monitoring yourself. There is a lot of room for improvements in corporate governance, which is a good thing because you can really make a difference by bringing in those principles. And there is also a lot of opportunities to incentivize management with the stock options, the long-term profit sharing plans, because they're not as common as in the developed world. Look at a typical company, you'll realize that they have no stock options. And you can bring all these new concepts to align interests with management and ride the second stage of the growth of the company.
I think system
I'll share a couple of case studies from our investments. For example, this is a company that we made 9 times in hard currency. So this was a bet that we have made in the consumer story of Turkey. We invested in 2008. Turkey was just benefiting from a huge growth of organized retail. People were having a lot of malls, building up a lot of shops, opening, and people were getting richer, so they wanted to get this experience rather than going through the unorganized retail. And the company has actually grown 20-fold. We had to, and when we entered the company, they made no money from retail. They were mainly a wholesale company, and we had to ride through that transition. We had to build a new management team who understands retail. We had to put in the KPIs. We had to bring a lot of knowledge from the Western world to be able to operate that. And by the time we exited it, they were making 70% of their revenues from retail. So, and obviously, Turkey's consumer story helped a lot, because it's very difficult to do the same thing now that the GDP per capita growth story is not there anymore. This is another investment. So this was a bet that we made on digitalization. We own the Turkey franchise of Domino's Pizza. When we entered the company, it was predominantly a call center business in the sense that 80% of the orders came from calling the stores, calling the central headquarters. It was very difficult to engage with customers. It was very difficult to do a loyalty program, to do social marketing. But then over our investment period, we stayed around 9 years there. It became a digital company. By the time we exited, it was around 80% of the sales coming from the online channels, a lot of engagement, customized campaigns for the customers, doing regional campaigns based on the competitive dynamics, and it has really helped us grow this story. We had a lot of local competition, which had advantages because they were more mom and pop, they could do a lot of things out of books. Obviously, as a corporate setup, we didn't do any of those, but still we could create a competitive advantage for ourselves by playing on the digitalization growth. The last one, this is just to give you a perspective that investing in emerging markets doesn't always mean that you have to take for example, a local currency risk. In EM, there are a lot of companies who do business with hard currency. This was a flexible packaging asset we owned, and they were the largest supplier to P&G in the region, so they were in the hygiene category. So they had a lot of growth potential because P&G was very happy with them, and they didn't just work with P&G in Turkey, but all the region. So we were able to make 2 times in just 2.5 years, so it was a quick flip. And there are possible, because of the low dynamics, we were able to get a vendor loan, which means that paying installments. We were able to leverage the low cost structure in Turkey and make a quick flip based on those. So when you're thinking about emerging markets, don't think that you will have to take a lot of currencies. There are actually 2 categories. Are you selling to emerging markets? Is your market in emerging markets? then you will have to take some currencies. But if you're looking at assets that are based in emerging market but selling abroad, that's actually to your benefit that there is a devaluation, because you're using the cost base of the local economy and selling abroad. Then you have to look at different factors, obviously. Political risks become a big of a problem, external relations become another factor that you need to consider. But there is a wide space that we could look. We shouldn't just think about one type of investment when we think of EM. So that's all I have to say. Thank you.
Thank you, Hala. That was incredible. Really informative. Some amazing returns. Some of that 55% return. Who wants one of those, right? That sounds good. Great, we got some people still awake. We are getting close to lunch, but before we leave, I want to give the opportunity for Hala to answer a couple questions. So let's limit it to two. Who has a question for Hala? Right over there. Another gentleman from Turkey. We talk some Turkey language. I love your country. I love your country. If you haven't been, definitely go visit Turkey. What do you got for us today?
Hello.
Hi.
I have a question for you. How do you decide when to exit? Because I know that you're still holding some biggest companies in Turkey. So how do you decide which company you should exit and when you should exit?
It's a very good question, because it's one thing to do a lot of growth and a lot of good returns in EM. It's another story to exit them. And we have a good track record. We have already exited 21 of the 30 investments we hold. The lesson there is to start exit process early. For example, the Mavi investment that I was talking about, we started that in 2016. We were able to exit in 2018 because we had a lot of volatility in 2016 and 2017. So you should always be ready. In emerging markets, exit is not like a month thing, it's a year's thing. You need to start talking to the strategics. If it's going to be an IPO, you need to start prepare, then the market closes for 2 years and then it opens up and you have to be ready when it opens up. So you should always be prepared, and we always try to invest in things with several exit options. For example, if there's a potential strategic buyer for that asset, it's a big plus. If there is no strategic buyer, we think that the public markets could be an exit route. In the old days, we had a lot of financial investors looking at Turkey, but not anymore, so that's not like always a stable way. We try to diversify in terms of exit routes and try to pick assets. It's like, even before looking at returns, we look at whether we can exit this or not. Sometimes we see great returns, but there's no exit route, so we don't invest in that asset.
Very much.
Okay, we got one more question. Oh, you got one over there? Okay, we'll squeeze in two. Thank you.
It's going to be very quick. Thank you so much for the intervention. Awesome content and very good returns. As a matter of fact, I've been investing in EM for a long time, and I think one of the key assets for increasing the trust for these countries, I come from Russia, in fact, so you can easily imagine how hard it is right now, is research. When you don't have much of information regarding an emerging market, you want to know more, and just as you said during the intervention, you gotta be on the field, you gotta talk to the companies. How do you gauge that? How do you do that? And if you can share that. Of course, it's a very sensitive topic. I know you cannot say much about it, but how do you do that? Thank you.
For example, for the shop that I have, we have 20 people on the field, and we've been in that field for the last 20 years, and we have, with the portfolio companies that we have so many local connections now, so it's so much easier to find acquaintances, to find information about people. A lot of investors always ask us that, why don't you invest in neighboring countries as well? But we always refrain from that because we don't have the advantage we have in Turkey in those markets. We don't know anybody, we don't know the local specifics. So we would be just money chasing assets rather than know-how chasing assets. So it's just making sure that you stick to the area that you know. Sometimes it becomes very difficult because you see a lot of very attractive opportunities, but you should always think, do I have any advantage? Do I have an angle into this investment rather than just money, you know? So that's what we try to do.
Great, okay, we're moving along. One last question before we break. Here we go. Please stand up, let us know your name and where you're from.
Hi, good afternoon. Excellent session. My name is Hale Ozsoy. I'm CEO of Hale Ozsoy Biyikli. I've got a speaker session and a panel discussion this afternoon, so I introduce myself here. The question that I had for you, since you're from Turkey, given the political sort of situation in the country and then obviously the currency devaluation that we've seen in the recent past, I mean, how do you see statistically, and then connected part of that is obviously the repatriation of the risk around repatriating funds from back out of Turkey. So how do you see the level of investment coming into Turkey at this present point, and how do you sort of advise the investors?
Yeah, thank you for that. There has been a lot of volatility in that. When I started again in 2008, we had around 20 funds investing in Turkey. There was so much money, everybody had their arms in Turkey. In our office, we would always have these visitors trying to engage us about how to co-invest and all that. But now, obviously, that's not like that. We have like 4 or 5 shops that have stayed in Turkey. Because, as you said, the capital has dropped and we are paying a lot of prices for that. But if you look at the local houses, ourselves being one, there are several others, we're still in business because we try to steer our strategy depending on the context. So if we have a lot of, if Turkey is doing well, if there is a consumer story, if we think that the TL has no pressures going forward, we invest in many TL assets. But now, for example, when there is a lot of TL volatility, we try to prioritize over assets that have hard currency, like the export assets or digital assets, which have so much growth that even if you have 50-60% devaluation, you can still post a lot of good returns. And we always try to stay away from really regulated industries where we cannot control anything. So we don't invest in defense, for example. There are very good companies operating in that, but we refrain from doing that because if something happens, it will be very difficult for us to steer strategy. That's how we try to look at it.
Fantastic. Well, that's going to stop our morning. Hale, thank you so much.